Welcome back to the Deep Dive. Today, we are doing something a little bit different. Usually, we take a book or maybe a set of articles and we break it all down. Today, we're taking on a single document.
A single, and I would argue, arguably the most important unread document in the entire American business world.
I think you're right. If you run a company, if you have a side hustle, if you invest in anything, really, this document controls a part of your life, whether you realize it or not.
Oh, absolutely. It's the ghost in the machine.
We are talking about the 2025 General Instructions for Certain Information Returns. And I know what you're thinking when you hear that title.
Your eyes glaze over.
Exactly. You hear IRS instructions and your brain it wants to shut down. It sounds drier than toast.
I mean, it
sounds like the thing you pay your accountant a lot of money to worry about so you don't have to.
And that's a common reaction. It's understandable. But ignoring this document, especially this year, well, it's dangerous.
It is. And this is exactly why I wanted to do this deep dive. Because when you actually force yourself to open this thing up, which, we've done for you.
We've taken the hit.
We have.
Yeah.
You realize this isn't just about paying taxes. It's not just about what you owe on April 15.
Not at all. That's a fundamental misconception. The 1040 is the final score. This is the play-by-play.
Oh, that's a good way to put it. This is about this. This massive, invisible web of data that the government uses to track the flow of money through the entire economy. It is a surveillance map. It's a blueprint for how the machine watches the money.
That's the perfect description. I call it the compliance architecture. It's the invisible plumbing that keeps the entire tax system functioning. When people think IRS, they think about their personal tax return, the 1040.
Right.
But the information returns, the whole family of 1099s, the 1098s, the W-2Gs, those are the real workhorses of the system. They are the reporting mechanisms that tell the government who paid whom, for what, and when they did it. It's the who, what, where, and how much of American capitalism.
And the sheer scale of it is what really hooked me. I mean, we're not just talking about your standard 9-to-5 paycheck. We're talking about, everything.
Everything.
Gig work on Upwork, right? Crypto trades on Coinbase, gambling winnings from Vegas, the mortgage interest you pay, the student loan interest, selling your house. It feels like every single time money moves in 2025, one of these firms gets triggered.
That is the ultimate goal. From a tax administration perspective, the ideal state is that every single transaction has a corresponding data packet. This document, the 2025 instructions, it's the rule book for how every business, every broker, every online platform has to generate those packets for the upcoming year.
So if you run a business, even a tiny one,
you're a deputy. You've been conscripted into this massive data collection army.
And there are some huge, truly massive changes this year. We're looking at what I can only describe as a total crackdown on digital assets.
A formalization, yes.
A formalization.
Yeah.
Okay. And then there are these very confusing shifts for gig workers and a mandate that, for all intents and purposes, kills off paper filing for good.
The death of paper is a huge theme in the 2025 instructions. It is truly the end of an era. The IRS is officially done with paper cuts.
So our mission today is to decode all of these changes. We're going to walk through what we're calling the 2025 Information Return Playbook. We'll dig into the new crypto rules, the e-file revolution, and some of the hidden traps, like something called a B notice, that can cost businesses thousands and thousands of dollars in penalties.
And I think we have to start with the biggest headline. It's right there in the What's New section. It just jumps right off the page. The digital asset revolution has finally, officially, hit the tax forms.
Yes, let's do it. Section 1, the digital asset revolution. I saw this in the source material, and honestly, my jaw dropped a little. There's a brand new form in town, Form 1099-DA.
Digital asset proceeds from broker transactions.
It just sounds so official.
Yeah.
It sounds like something out of a cyberpunk novel.
It's very official. And, it's been a long time coming. For years, we've had this massive ambiguity in the crypto space. If you bought and sold Bitcoin, or if you were trading Ethereum, flipping NFTs, the reporting was, let's call it spotty.
Spotty is being very generous. It was the Wild West.
It absolutely was. Some exchanges would send out forms, some wouldn't. Some would send a 1099-K, which is really designed for credit card processing, and it just didn't fit the crypto model. It didn't show your cost basis, what you actually paid for the coin.
Right. It just showed what you sold it for. Not very helpful.
Not helpful at all for calculating your gain or loss. So the IRS felt, and they've been saying this for years, that there was a massive visibility gap.
They were flying blind.
Essentially, They
Wow.
knew billions, maybe trillions of dollars were moving around. They could see the market caps of these coins skyrocket, but they couldn't see the specific taxable events for individual taxpayers.
Hmm.
This new form, the 1099-DA, is designed to close that gap permanently.
And the instructions, they're very clear that this isn't just an IRS whim.
Oh, not at all. They explicitly state this is driven by the Infrastructure Investment and Jobs Act. It's statutory.
Meaning, this isn't just the IRS waking up one day and deciding, hey, let's make a new form. Congress mandated this.
Correct. It's not just the IRS making up a rule on a Tuesday. Congress passed a law that said you will do this. The whole idea is to treat digital assets in exactly the same way as traditional stocks or bonds for reporting purposes. They want parity.
So let's walk through the user experience here.
Yeah.
If I'm trading stocks on, say, E-Trade or Robinhood, at the end of the year, my broker sends me a 1099-B.
Right.
And it tells me what I sold, the day I sold it, what I got for it, and crucially, what I bought it for, my cost basis. And then it calculates my gain.
Correct. That 1099-BB is the reason doing your taxes for stock trades is relatively easy these days. You just import the data into your software.
And the 1099-DA is designed to be the 1099-B for the crypto world.
Precisely. It standardizes the reporting of proceeds. It requires the broker to report the gross proceeds from the sale of digital assets. Now, the cost basis part is being phased in. It's a bit more complicated. But the first step is just reporting the sale.
But the complexity here just seems so much higher than with stocks.
Yeah.
I mean, with stocks, custody is simple. It's at the brokerage. With crypto, you've got wallets, you've got decentralized exchanges, you have staking, lending. Does the form actually cover all of that?
The instructions are casting a very, very wide net. They use the term brokers. And under the new expanded definition, a broker in the digital asset space is pretty much anyone who effectuates transfers of digital assets on behalf of another person.
So the big exchanges, obviously. Coinbase, Kraken, Binance.
They're the obvious ones. But the definition is pushing into more decentralized territory, too. If you run a crypto kiosk at the mall or a wallet service that facilitates trades between users, you might now be on the hook to file these forms. The definition is broad for a reason.
What I found really fascinating in the source text, though, is that they didn't just add a new form. They actually had to change the parent form, Form 1096, just to accommodate it.
Right. Form 1096, for those who don't know, is the summary sheet. It's like the cover letter you send in if you're one of the few people still mailing paper forms to the IRS.
Which we'll get to. You should be.
Exactly. But this form basically says, hello, IRS. Attached is a stack of 50 1099 NECs from my company. They've had to revise Form 1096 specifically to add a little checkbox for the 1099-DA.
It sounds like a small detail, but it shows how deeply they're integrating this into the system.
It's now a permanent fixture of the tax landscape. It's not a temporary fix. It's part of the core architecture now.
Okay, but there was a very specific procedural note in the instructions about this new crypto form that I really want to highlight. It felt like a warning shot from the IRS. It says you cannot use the old system to file it.
That is a crucial detail for any compliance officers or business owners listening. The IRS has two main electronic filing systems. There is the legacy system called FIRE.
FIRE.
Stands for Filing Information Returns Electronically. It's the old workhorse. It's been around for decades. And frankly, it looks like it was built in the 90s because it was. And people still use this system. Oh yeah, massive institutions still use it. The big payroll companies, the banks. It works. It's reliable for huge batches. But for Form 1099-DA, the instructions are explicit. You cannot use FIRE. You must e-file it through their new system, IRS.
IRS. That sounds a bit friendlier.
It stands for Information Reporting Intake System. It's their modern web-based portal, and the fact that they are forcing all 1099-DA filings into this new system tells you everything you need to know.
What does it tell you?
It tells me they want this data clean. They want it fast, and they want it in a modern XML format that their computers can easily analyze. They don't want the new, valuable crypto data going into the old legacy bucket with everything else. They want it in the new analytics-ready bucket.
It really signals that the Wild West era of crypto is officially over, at least as far as the IRS is concerned. They are building the infrastructure to see every single trade. The key word for this entire deep dive is visibility. They are systematically turning on the lights in every dark corner of the economy.
And speaking of visibility and modernization, that leads us perfectly into the second major shift in these instructions, the e-filing mandate. This is our Section 2, the death of paper.
It truly is the death of paper. There's no other way to put it.
This one, it just blew my mind. because I remember, and it wasn't even that long ago, the threshold for having to file electronically was pretty high. If you were a small business, you could just mail everything in.
It was. For a very long time, the rule of thumb was 250 returns. If you had to file 250 or more forms, you had to do it electronically. If you filed 249, you could, stick them all in a big envelope, put a bunch of stamps on it, and mail it off to Austin or Kansas City.
Which, even 249 forms, that seems like a mountain of paper. That's a thick envelope. That's almost a ream of paper.
It was often a literal box of paper. And you have to imagine, on the other end, the IRS had to hire people to open millions of those envelopes, unfold all the paper, and manually type the numbers into a computer. It was insanely inefficient and prone to error.
So that's gone.
That is gone. The instructions point to Treasury Decision 9972. The threshold has dropped from 250 down to 10.
10, not 100.
Yeah,
10. 10.
Yeah.
T-E-N.
That's virtually everyone. I can't think of business that wouldn't hit that.
It is effectively a universal mandate. Even a very small mom-and-pop shop, a tiny consultancy, will hit 10 forms so easily. And here's the gotcha. Here's the part that usually trips people up.
I love a good gotcha.
The calculation is an aggregate count.
Okay, let's unpack that. What does aggregate mean in this context? Because that sounds important.
It's the most important part. It means you don't look at the forms individually by type. Let's say you're a small graphic design agency. You have maybe 4 full-time employees. So you're filing 4 W-2s.
Okay, 4 forms. I'm under 10. I'm safe. I can use paper. Not so fast. You also paid a freelance copywriter for a project. That's one 1099 NEC. You paid a photographer. That's another 1099 NEC. You paid an illustrator. That's a third. So now you're at 7 total forms.
Okay, still under 10.
But you also pay mortgage interest on your small office building. The bank needs a 1098 from you. That's 8. You paid your lawyer for some legal advice. That's a 1099 NEC. That's 9. And you paid interest to an individual who loaned your business some startup money. That's a 1099 INT. That's 10.
I see where this is going. It piles up incredibly fast.
In the old days, you'd look at each pile separately. Well, I only have 4 W-2s. That's under 250. I only have a few 1099s. That's under 250. You can mail them all. Now you have to add them all up. 4 plus 3 plus 1 plus 1 plus 1. If the total number of all information returns you file across all the different types is 10 or more, you must e-file everything.
Wow. So to use their example from the text, if I file 4 1098s and 7 1099 NECs, that's 11 total. I'm digital. End of story.
You're digital. No stamps for you. And frankly, you shouldn't want to use stamps anyway. E-filing is faster, it's more secure, and you get an immediate confirmation that the IRS received your file. Paper just goes into a black hole for a few weeks.
Well, the instructions seem to be practically begging people to stop using paper, even if they're one of the few who fall under that 10-form threshold. There was this section about OCR and Copy A that sounded like something out of a sci-fi manual from the 80s.
Yes. This is fascinating. The IRS admits, right there in the text, that they process paper forms using optical character recognition machine reading. A robot reads your taxes.
So it's not a person in a green visor sitting there typing it all in?
No, that would be impossible with the volume they get. It's a high-speed scanner. And because of that, the instructions are incredibly strict about the physics of the paper itself.
Yeah.
You cannot just go to the IRS website, download a PDF of a 1099, print it out on your office laser printer, fill it in and mail it.
You can't. I feel like everyone has done that at some point, or at least seen someone do it.
You absolutely cannot do it for Copy A. That's the copy that goes to the IRS. The reason is that the downloadable PDF from their website uses standard black ink for the form itself. The official scannable IRS forms use a specific dropout red ink.
Dropout red ink. What is that?
It's a special shade of red that is invisible to the scanner's light. So when the machine scans the page, it doesn't see the lines of the boxes or the text of the instructions. It only sees the black type that you entered onto the form. The red background drops out.
Oh, that is wild. So if I print a black and white form from the website and send it in, the machine gets confused.
The machine completely freaks out. It sees all the grid lines and the box labels as data. It can't distinguish your numbers from the form's template. It breaks the OCR. And the instructions explicitly warn, and I'm quoting here, you cannot file Form 1096 or Copy A of forms that you print from the IRS website. If you do, you could get hit with a penalty for filing a non-scannable, non-compliant return.
So the days of typing out a stack of forms, even on a typewriter, are officially over for almost everyone. And if you're one of the few holdouts, you can't even just print a form from your computer. You have to order the special reading stationery from the IRS or go buy it at an office supply store.
Exactly. They are making paper so inconvenient and the electronic threshold so ridiculously low that you will naturally migrate to their IRS portal. They are gently, or, not so gently, shoving everyone into the digital age.
So let's talk about IRS versus FIRE again, because the instructions spend a good amount of time on this. What is the actual difference for the user? Why do we even have two systems?
It's a legacy issue. FIRE is the old system. Again, filing information returns electronically. It's incredibly powerful, but it's also incredibly clunky. You usually need specialized accounting software, like from a major payroll provider, to generate the specific file format it requires.
It's not like a Word doc or a PDF.
Oh, God, no. It's a specific ASCII format that's defined in another 100-page document called Publication 1220. It's really for the pros doing bulk filings in the tens or hundreds of thousands.
So if I'm just a guy with a small business and, say, 15 forms to file, FIRE is probably way too much for me.
It would be a nightmare. You have to apply for something called a TCC, a transmitter control code. You have to do testing with their system. It's a whole process.
And IRS.
IRS is the new friendly face. It's a free online portal. The instructions make it clear you can just log in and literally type the data in manually, screen by screen. It looks and feels like TurboTax or any other modern web form. Or, and this is the best part for small businesses, you can upload a CSV file.
Which is basically a simple Excel spreadsheet.
Exactly. You can put your data in a spreadsheet, save it as a CSV, and just upload it directly. There is really no excuse anymore. They've removed every barrier.
The message is clear. We made it free. We made it accept spreadsheets. Please, for the love of God, stop sending us paper.
That is the subtext of this entire section, yes.
Okay, let's move on to Section 3. This is the one that I think generates the most confusion in the real world, the so-called gig economy rule, or as I call it, the 1099K confusion. This has just been a roller coaster for the last few years.
Ah, yes. The ongoing saga of the third-party settlement organizations.
That's a mouthful. Let's just say Venmo, PayPal, Cash App, eBay, Etsy, StubHub, those platforms.
Correct. Any organization that processes payments for goods and services between two other parties.
So reading the 2025 instructions, I see a reference to something called Notice 2024-85, and it talks about transition relief. Can you just explain what on earth is going on here?
Okay, to understand the relief, you have to understand the original law. The American Rescue Plan Act a few years ago changed the law. It said that if you receive more than $600 in payments for goods or services through one of these apps, the app must send you and the IRS a Form 1099-K.
Which is a very, very low threshold. If I sell a used couch on Facebook Marketplace and a lawnmower on eBay, or I sell a couple of Taylor Swift tickets I couldn't use, I might hit $600 very easily.
Exactly. And that realization created a full-blown panic. Millions and millions of people who do not think of themselves as businesses would suddenly be getting official tax forms.
Right, and the IRS would be getting copies.
And that's the key. The IRS realized that enforcing this $600 limit immediately would crash the system. Their phone lines would melt down. You'd have grandmas getting tax forms for selling knitwear on Etsy. You'd have people getting forms for splitting dinner bills with their friends. If they didn't tag the Venmo transaction correctly as non-business, it was going to be an absolute mess.
So they blinked.
They've blinked a couple of times now. They're phasing it in. That's what Notice 2024-85 is all about. The instructions state that for tax year 2025, the returns we're preparing for now, the threshold is going to be $2,500 in total payments.
Okay, so that's a bit higher. If I sell, say, $2,000 worth of stuff on Etsy in 2025, I will not get a form.
Correct. If you are under $2,500 for 2025, you are safe from the paperwork for one more year. But, and the instructions are very, very clear on this, for calendar year 2026 and beyond, it drops to the statutory $600 limit.
So this is the final warning. The training wheels are coming off.
It certainly appears to be the final step down. They had a higher threshold, then they announced a step down to $5,000. Now they're saying $2,500 for 2025, and then the full $600 enforcement hits in 2026. It's a gradual tightening of the net. They're giving the platforms and the public time to adjust.
It really just reinforces that theme of visibility again. They want to see the gig economy. They know there are billions of dollars moving through these platforms that aren't being reported as income.
And by lowering the threshold, they formalize that entire economy. If you get a form, the IRS gets a copy. If the IRS gets a copy, their computer system fully expects to see that number show up on your tax return. It removes the honor system element of it all. It forces compliance through data matching.
Simple as that.
Well,
Now let's talk deadlines. Section 4. Because missing a deadline in this world is expensive, and the calendar is surprisingly complicated.
It is a minefield. And it's a minefield because different forms have different due dates. And there's a critical distinction that people often miss between furnishing a return and filing a return.
Okay, break that down for us. Furnishing versus filing.
Furnishing means sending the form to the person you paid, the recipient, your contractor, your employee, the person whose mortgage interest you received. Filing means sending the data to the IRS. These two actions often have different deadlines.
The instructions list a few key dates. January 31st seems to be the big one.
January 31st, or the next business day if it falls on a weekend, is the big one. It's the furnishing deadline for most of the common forms, especially the 1099 NEC for non-employee compensation.
That's the one for freelancers and contractors.
Exactly. The law says you must give that form to the recipient by January 31st. It has to be in their hands, or at the very least, postmarked in the mail by that date.
And why is that one so early?
Because that freelancer needs that form to file their own taxes. Their ingrain porting depends on the forms you send them. If you delay sending it, you delay their ability to file accurately.
Okay, that makes sense. But then there's this weird one, February 17th.
Right. February 17th is a special later furnishing deadline specifically for Form 1099-B, which is from brokers, and 1099-S, which is for real estate transactions.
Why do they get extra time?
Those industries successfully lobbied and argued that they need more time to finalize their numbers. If you're a massive stock brokerage, calculating the cost basis for millions of wash sales and corporate actions by January 31st is just too tight, so they get an extra 2.5 weeks.
Got it. Now what about filing the forms with the IRS?
That deadline depends entirely on how you file. If you are one of the very few paper filers left in the world, your deadline to get that box of paper to the IRS is February 28th.
But if you e-file?
If you e-file, which, again, almost everyone must do now, you get an extra month. The deadline is March 31st.
So e-filing actually buys you an entire extra month of breathing room.
It does. It's another carrot they dangle to get you to go digital. File electronically, and you get until the end of March. Insist on filing with paper, and you have to rush for the end of February. The choice is pretty clear.
But here's the part that made me laugh out loud when I read it. We're sitting here talking about high-tech crypto forms, AI-driven surveillance, online portals, and then I stumbled upon Form 15397.
The extension request form.
The instructions say there's a brand new form, this 15397, that you use to request an extension of time to furnish the statements to the recipients. So if I'm a business and I know I can't get my 1099s out to my contractors by Jan 31, I use this form to ask for more time, but how do I submit it?
By fax only.
Fax only. I had to reread that line 3 times. An extension of time to furnish statements must be requested by fax only.
It is a wonderful, beautiful bureaucratic paradox, isn't it?
It's incredible. The official message is, you must e-file your returns because we are a modern 21st century agency. But if you need an extension, please find a machine from 1995 and dial 877-477-0572.
There is a logic to it, believe it or not, albeit an archaic one. The request for an extension to furnish is a very specific, very time-sensitive request. It doesn't go into the main data processing pipeline with the millions of returns. It goes to a specific small unit, the technical services operation. And apparently, their internal workflow is still built around the fax machine. It allows them to physically see the urgent requests coming in, separate from the flood of digital filings.
It just feels like a glitch in the matrix. I can upload a CSV file with 1 million crypto trades in it, but I have to fax my extension request.
It just proves that even in the middle of a digital revolution, legacy systems die hard. Sometimes the old pipes are still running right under the brand new pavement.
All right, moving on to Section 5. This is something I had honestly never heard of before preparing for this deep dive, but it sounds like an absolute trap for normal people. The concepts of pay and nominee.
Oh, this is a crucial section for avoiding trouble. Most people think a pay is just, an employee or a contractor you paid.
But the source text defines it much more broadly.
Much, much broader. A payee is basically anyone receiving a copy of one of these forms. The text lists beneficiaries, borrowers, debtors, donors, insureds, even contest winners. If you convey money or a benefit to someone that requires a form, they are a payee.
And then there's this nominee middleman rule. Explain this scenario, because this sounded like the classic accidental tax evasion setup.
It really is. Let's paint a picture. Let's say you and your brother decide to pool your money to open a high-yield savings account. or buy a certificate of deposit.
Okay, standard family stuff. You want to get a better interest rate by combining funds.
Exactly, but the bank only allows one primary name on the tax form, or maybe you just set it up in your name for convenience. So the bank has your social security number on file for that account.
So at the end of the year, I'm the one who gets the 1099 INT for all the interest the account earned.
Right. Let's say the account earned $1,000 in interest. You get a form from the bank that says you earned $1,000, but in reality, $500 of that belongs to your brother.
So I just give him his $500 in cash, and we're good.
Right. No. That is where you fail. That is the trap. Because the IRS's computer got a data feed from the bank that says you earned $1,000. If you then file your tax return and only report $500 of interest income, the IRS computer will flag the mismatch and automatically send you a bill for the tax on the other $500. It thinks you're underreporting your income.
So what am I supposed to do?
According to the rules, you are now a nominee recipient. You have to effectively become the bank. You are required to file a new 1099 INT with the IRS. On that form, you list yourself as the payer and your brother as the recipient for his $500 share of the interest.
Wait. I have to file a formal government tax document against my own brother.
Yes. You file it with the IRS and you furnish a copy to him. That way, the IRS's computers see the whole picture. They see, okay, host received $1,000 from the bank, but then paid out $500 to brother as a nominee. The net income for host is $500, and there's a corresponding form showing brother received $500. The math balances out.
That seems like an incredible amount of paperwork for a simple family arrangement.
It is, and the instructions mention that the only real exception is for spouses. Spouses generally don't need to go through this because they usually file a joint tax return anyway, so the money all ends up in the same pot. But for siblings, business partners, roommates who share an account, you absolutely have to follow the nominee rule to the letter.
I would bet that 99% of people get that wrong.
Oh, they do. And usually the amounts are small enough that it doesn't trigger an audit, but if it does, it's a mess to try and explain after the fact. The IRS agent will just point to the original 1099 and say, the bank says you made this money.
There was also a quick note in there about successor-predecessor reporting. This is for when businesses get bought out, right?
Yes, this is for our corporate listeners. It refers to Revenue Procedure 9950. The question is, if Company A buys Company B on, say, June 30th, who is responsible for sending out the W-2s and 1099s at the end of the year?
It sounds chaotic. Does everyone get 2 forms for the year, one from each company?
They might, if the companies don't plan ahead and agree on a method. The instructions say the 2 companies can agree to combine all the reporting. So the new owner, the successor, takes on all the liability and files one set of forms for the entire year, covering both the pre- and post-acquisition periods. Or, if they can't agree, they each have to file separately for their respective partial periods.
It's interesting how flexible that part is, if they agree. It sounds like it's a negotiable point in a merger.
It is exactly that. It's one of the line items in the sale negotiation. I'll buy your company, but you're handling all the year-end paperwork for the first 6 months.
Okay, let's jump to Section 6. This is where it gets a little scary. The B notice and backup withholding.
This is the enforcement hammer. This is where the IRS stops asking nicely and starts taking money directly.
And the rate is what caught my eye immediately.
Yeah.
24%.
That is the backup withholding rate. It's not a suggestion. It's essentially a penalty tax that you, as the payer, are required to collect up front and send to the government.
So explain how this happens. I'm a business. I hire a contractor. When do I have to take 24% of their pay and send it straight to the IRS?
The number one trigger is a missing or obviously incorrect TIN, the taxpayer identification number. That's usually a social security number for an individual or an EIN for a business. If a payee fails to give you a TIN on their Form W-9, you must begin backup withholding at 24% immediately.
You don't have a choice.
You have zero choice. If you pay them the full amount anyway and you didn't get a TIN, you become liable for that tax. The IRS can come to you, the payer, and say, you were supposed to withhold that 24%. You didn't. So now you have to pay it out of your own pocket.
Ouch. So I can't just be nice to the contractor who says, oh, I forgot my number. I'll get it to you later.
Being nice in that situation could cost you 24% of every payment you make to them. Get the W-9 first.
Okay, so that's the first trigger. What is a B notice? That sounds like being sent to the principal's office.
It basically is. B stands for backup withholding. You get a B notice, which is officially a CP 2100 notice after you've filed your returns. The IRS computer takes your file, say a 1099 NEC for John Smith, with TIN 123456789, and it checks that against its master database. If the database says, nope, that TIN actually belongs to Mary Jones, or that TIN doesn't exist, they send you, the payer, a B notice.
What does the notice say?
It says, your data is wrong. You have filed a return with an incorrect name-tin combination. You need to contact this pay immediately to get the correct information. And if they don't give it to you after a certain number of solicitations, you must start withholding 24% from all their future payments. It's a do not pass go order from the IRS.
It's like the IRS is telling the bouncer at a club to kick your contractor out.
Or at the very least, to confiscate their wallet at the door until they can produce a valid ID.
But the instructions do mention a way to avoid this whole nightmare, something called TIN matching.
Yes, this is the pre-check system. It's a free online service offered by the IRS where you can verify a name-tin combo before you even issue a payment, and certainly before you fail the return at the end of the year.
That seems like an absolute no-brainer for any business.
It is. Your analogy of checking ID at the door is perfect. If you check the ID before you let them in the club or before you pay them, you don't have to deal with the bouncer, the IRS, later on. The instructions heavily encourage using the TI matching system to avoid the B notice headache. It's free, it's online, and it saves you so much panic later.
There was also a small note about truncating TINs. This is a privacy measure.
Yes, and a very important one. Identity theft is a huge issue. If you're mailing a 1099 to a contractor, you don't really want their full Social Security number floating through the mail system where anyone could potentially steal it. The rules allow you to mask or truncate the first 5 digits of a Social Security number on the recipient's paper copy. So it would read something like Nextness 234.
But not on the copy that goes to the IRS.
Never, ever on the IRS copy. The IRS needs the full unmasked number to do their computer matching. But for that piece of paper going through the Postal Service, yes, absolutely truncate it. It's a simple step that protects your pays.
All right, Section 7 is where the rubber really meets the road financially. The penalties.
The financial pain section, this is the reason you read the instructions carefully.
And the numbers seem to have gone up again. What are we looking at for a simple failure to file on time?
It's a tiered system, and it's designed to reward fixing your mistakes quickly. If you're late, but you get the correct forms filed within 30 days of the due date, the penalty is $60 per return.
Okay, that's manageable. A slap on the wrist.
If you're later than 30 days, but you fix it by August 1st, it jumps to $130 per return.
To get a little steeper.
If you file after August 1st, or you just don't file at all, it's $340 per return.
$340 per return. So let's go back to my little graphic design agency example. If I had that stack of 11 different returns and I just completely forgot to file them.
That's $3,740 in penalties. Almost $4,000 just for a paperwork error, just for forgetting to upload a file. But that's not even the scary part.
What's the scary part?
The scary part is a little phrase called intentional disregard.
That sounds ominous.
It is. If the IRS determines that you knew you had to file and you just chose not to, or you willfully ignored B notice and kept using a bad TIN, the penalty is $680 per return. And here is the real kicker. There is no maximum penalty.
For the other tiers, there's a cap on the total penalty.
Yes. For normal negligence, the penalties generally cap out at a certain amount, around $4 million for large businesses. But for intentional disregard, the sky is the limit. They can penalize you into bankruptcy if the volume of forms is high enough. It's the penalty designed to punish outright defiance.
That is genuinely terrifying, but surely there's some mercy for small businesses who make honest mistakes.
There is. There's a small business exception with lower penalty caps if your average gross receipts are under $5 million. But the most important mercy rule, and honestly my favorite part of this whole document, is the safe harbor for de minimis dollar amount errors.
I loved this part. I called it the Butterfingers rule.
That's a great name for it.
Yeah.
Essentially, he says if you make a mistake on a form, but the error in the dollar amount is $100 or less, or $25 or less in the case of tax withholding, you don't have to file a corrected return.
So you don't have to go through the whole process of filing a correction.
Not unless the recipient specifically asks for one. The IRS basically decided that the administrative cost of them processing and you preparing a corrected return for a $40 error was more than the potential tax was worth. So if you accidentally report a contractor's income as $10,050 instead of the actual $10,090, you're safe.
That must save a massive amount of administrative headaches. I can just imagine the panic of realizing your accounting software was off by 12 cents on every form.
Before this rule came into effect, technically you had to correct it. It was absurd. Now, there is a reasonable margin of error. It keeps the entire system from clogging up with people correcting penny rounding errors.
Finally, let's touch on Section 8, the human element and miscellaneous. I always find it a little bit jarring when I'm reading a dense government document, all dry, legalistic text, and then suddenly there's a picture of a child.
The Missing Children Initiative.
The instructions explicitly mention the IRS's partnership with the National Center for Missing and Exploited Children.
It's a long-standing partnership. They use the blank space in the printed instruction booklets pages that would otherwise just be white space to print photographs of missing children. It's been going on for years.
It's just a very sobering reminder that this massive bureaucracy, it still touches real people and real lives. It's not just machines and algorithms and penalties.
It is. It's a very human touch in what is otherwise a very inhuman document.
And the other miscellaneous item that stood out was about private delivery services, or PDS.
The FedEx and UPS rule.
We've established that you shouldn't be mailing things. But if you absolutely must mail something, maybe you missed the e-file window for some reason and you're desperate, you have to be very careful about how you mail it.
That's correct. You are allowed to use designated private delivery services like FedEx, DHL, or UPS, and the postmark date will be honored, just like with the U.S. Postal Service. But, and this is a very big but, they cannot deliver to an IRS P.O. box.
Right, because the FedEx driver doesn't have a key to the post office box.
Exactly. Only the U.S. Postal Service can access a P.O. box. So the instructions list the specific street addresses for the submission processing centers in Austin, Kansas City, and Ogden. If you send your FedEx envelope to IRS P.O. Box 123, it will be returned to you as undeliverable.
And you will miss your deadline. And you will pay that $340 per form penalty.
You will. Details, details, details. That is the entire theme of this document.
It really is. It is a game of precision. The IRS does not reward approximation or good intentions.
Not at all.
So let's wrap this all up with our outro. What does this all really mean? When I look at the 2025 instructions as a whole, the new crypto forms, the 10-return e-file threshold, the ever-lowering gig economy limits, I just see a net, and it's being tightened.
It is absolutely a tightening. 2025 is the year of digital enforcement. The informal economy is being systematically formalized. The paper economy is being forcibly digitized.
It feels like the IRS is saying, we know the data is out there, and we are now going to build all the pipes required to suck it all into our central system.
That is the compliance architecture I mentioned at the very start. The move to the 1099 DA is the perfect example. It shows that the IRS is adapting to modern technology much faster than most people give it credit for. They aren't waiting for the crypto world to stabilize. They are regulating it into the existing framework right now. They're building the cage around the digital beast.
And here's my final provocative thought for our listeners. We're seeing a world where nearly every transaction, whether you're selling a crypto token or you're mowing a lawn for your neighbor through an app, is becoming instantly visible to the taxman via these information returns. And at the same time, we have these safe harbor rules that basically say, hey, don't worry about the pennies. We don't care about a $50 error.
Right.
To me, that suggests the IRS doesn't care about the individual dollars as much as they care about the data feed. They want the flow of information more than anything else.
That is a very sharp observation. The data is ultimately more valuable than the immediate tax revenue on a small error because the data allows for perfect enforcement at scale later on.
So if the reporting system becomes this tight, if the data feed becomes this comprehensive, how long is it until filing your taxes becomes obsolete? Why do I need to sit down and fill out a 1040 if the IRS already has every single 1099, W-2, and 1098 associated with my Social Security number? Why don't they just send me a bill or a refund?
That is the return-free filing concept. Many other developed countries already do this. In the UK or Japan, for most wage earners, they don't file a return. The government calculates it for them. With the changes in these 2025 instructions, the universal e-filing, the crypto capture, the 1099K reporting, we're technically one massive step closer to that reality. The IRS has all the puzzle pieces. They're just waiting for the political authority to put the puzzle together for you.
A scary or a convenient thought, depending on your perspective, I suppose.
Indeed. It's the classic trade-off of total visibility. Convenience comes at the cost of a certain kind of privacy.
Until that day comes, check your payee status. Make sure your TINs are correct. And for the love of everything holy, do not ignore a B notice.
And please stop using paper.
And stop using paper. Thanks for listening to The Deep Dive. We'll see you on the next one.